What you are witnessing right now in the crypto market is not just another price swing. It is one of those moments that years later, people will look back on and say, that was the turning point, but we didn't recognize it at the time. I want you to pause for a second and really look at what has happened in just a few weeks. Bitcoin, which not long ago was trading near its historical highs, suddenly plunged. Volatility spiked, headlines turned dark, and the emotional temperature of the market dropped almost overnight. To many observers, it feels like the beginning of a collapse. But I want you to listen carefully, because what is happening beneath the surface is far more complex and far more important than a simple sell-off. If you look closely, the first signals were subtle, almost easy to miss. Funding rates in derivatives markets began to normalize. Open interest started declining. Liquidations were happening, but not in chaotic waves like we saw in 2022. This wasn't the sound of a building collapsing. It was the sound of pressure being slowly released from a system that had become stretched. And when you see markets move in this way, orderly deleveraging rather than panic liquidation, it tells you something very specific. It tells you that large players are adjusting positions, not fleeing the market entirely. I've seen this pattern before, not just in crypto, but in equities, in commodities, and even in sovereign debt markets. In 1998, during the LTCM crisis, the market didn't collapse overnight. Leverage unwound in layers. In 2013, during the taper tantrum, capital rotated violently but systematically. And in March 2020, when liquidity evaporated across global markets, the first sign of stabilization wasn't rising prices. It was the slowing pace of forced selling. What we are witnessing now carries echoes of those moments. History doesn't repeat perfectly, but the rhythm of financial stress and release is remarkably consistent. Now, let's talk about the real reasons behind what is happening, because the headlines rarely tell the full story. This downturn is not being driven primarily by retail panic. It is being driven by macro forces, liquidity conditions, real interest rates, and the behavior of institutional capital. Over the last few years, Bitcoin has transformed. It is no longer a fringe asset traded mostly by enthusiasts. It has become part of the global macro landscape. That means it reacts to the same forces that move equities, bonds, and currencies. When liquidity tightens, when risk appetite contracts, when capital seeks safety, Bitcoin feels that pressure. But here's the part many people miss. Tightening cycles and deleveraging phases are not the same as structural collapse. In fact, they are often prerequisites for the next expansion. Excess leverage builds up during bull markets, and that leverage must be cleared before a sustainable advance can begin again. Think of it like a forest after a controlled burn. It looks destructive in the moment, but it removes the dead material that would otherwise fuel a catastrophic fire later. I also want you to consider what is happening globally, because this is not a local phenomenon confined to crypto exchanges. Look at bond markets. Look at the behavior of the dollar. Look at capital flows into money market funds and short-term treasuries. Across the financial system, investors have been repositioning, reducing risk, and waiting for clarity on inflation, growth, and monetary policy. Crypto is simply one piece of that broader puzzle. When global liquidity contracts, risk assets, from technology, stocks, to emerging markets to digital assets, tend to move together. This is not coincidence. It is the structure of modern finance. And yet, here is where the contradiction appears, and it is an important one. Even as prices have fallen, many of the underlying indicators of long-term demand have not collapsed. Network activity has not vanished. Institutional vehicles continue to see intermittent inflows. Volatility, while elevated, is nowhere near the extremes of previous bear markets. These are not the conditions of a market being abandoned. They are the conditions of a market being reset. I want you to think about that word carefully, reset, because resets are uncomfortable. They create doubt. They test conviction. They make even experienced participants question their assumptions. But resets also serve a function. They redistribute risk, transfer assets from weak hands to strong hands, and establish new foundations for future growth. Every major financial cycle in history has included these phases. The technology bubble in the early 2000s, the commodity boom of the 2000s, even the long equity expansion after 2009. All of them experienced moments when sentiment collapsed, even as structural trends remained intact. So, where does that leave us right now? It leaves us in a moment of tension, a moment where fear and fundamentals are pulling in opposite directions. And when you stand in front of a market like this, you have to make a decision, not about what to buy or sell, but about how to interpret what you are seeing. Are you witnessing the beginning of a long decline, or are you witnessing the painful but necessary stage of a cycle resetting itself? From where I stand, after years of watching markets move through crises, bubbles, and recoveries, what I see is not chaos, but transition. The signals are broken, the headlines are loud, and the emotions are intense. But beneath all of that, the mechanics of the market are functioning exactly as they have in previous cycles of stress and recovery. And that is the key point I want you to take with you. The most important turning points in financial history rarely look like turning points when you're living through them. They look like uncertainty, like fear, like a nightmare that feels as if it might never end, right up until the moment it does. I want you to step back with me for a moment and look at this market not through the lens of days or weeks, but through the lens of cycles, because what is happening right now only makes sense when you place it inside a larger timeline. If you focus only on the recent drop, it feels chaotic, unpredictable, even frightening. But when you zoom out, you begin to see something else emerging, a structure, a rhythm that has repeated itself again and again in financial history. What you are witnessing now is not just a sell-off, it is a phase in a post-halving cycle unfolding under entirely new conditions. And I want you to really understand what that means. In earlier eras, Bitcoin moved primarily on retail enthusiasm, momentum, and speculative capital. Today, that is no longer the dominant force. Institutional capital, structured products, and long-horizon allocators now shape the flow of money into and out of this market. That changes everything, especially the way downturns unfold. Think about the mechanics of a halving cycle. Supply growth slows, but the impact is not immediate. Markets anticipate events long before they occur, and often prices rise in advance of the actual supply shock. Then something very predictable happens. Expectations run ahead of reality, leverage builds, and once the event passes, the market enters a period of digestion. This is not failure. This is not collapse. This is digestion. And digestion, as uncomfortable as it feels, is an essential phase of every major financial expansion. You have seen this before, even if you didn't realize it at the time. After the 2017 cycle peak, the market didn't move straight into a new bull run. It spent years resetting. After the extraordinary stimulus-driven rally in global equities in 2020 and 2021, markets didn't continue rising in a straight line. They entered a volatile consolidation as liquidity conditions changed. These are not anomalies. They are the normal breathing pattern of markets that have moved too far, too fast. Now, I want you to pay attention to something that many commentators overlook: the behavior of large capital. Retail investors often react to headlines, but institutions react to conditions. And conditions right now are not signaling abandonment, they are signaling repositioning. When volatility rises but markets do not collapse, when drawdowns occur but liquidity remains functional, when flows slow but do not reverse completely, those are signs that capital is rotating, not fleeing. Look at how pension funds, sovereign wealth funds, and large asset managers behave in other markets. They do not chase peaks. They build positions during periods of uncertainty. They think in quarters and years, not in days. That mindset is now part of the crypto market structure. And that means downturns can look quieter, slower, more controlled than the violent collapses of the past. But there is another layer to this timeline that you must understand, and it is the macroeconomic backdrop. Bitcoin does not exist in isolation. It exists inside a global financial system that is currently navigating one of the most complex transitions in decades. Inflation shocks, aggressive monetary tightening, shifting trade dynamics, and the gradual normalization of real interest rates have reshaped the investment landscape. When real yields rise, risk assets feel pressure. When liquidity contracts, speculative assets weaken. This is not unique to crypto. It is a universal law of capital markets. Think back to the early 1980s, when Paul Volcker's tightening cycle forced a painful adjustment across global markets, or to the period after the dot-com bubble, when the technology sector spent years rebuilding before entering its next great expansion. Major structural shifts do not resolve in months. They unfold over years. And yet, during those long transitions, markets repeatedly produced rallies, corrections, and consolidations, each one confusing observers who expected a simple, linear trend. What we are seeing now fits that pattern more closely than many people realize. The current phase is not the end of a cycle. It is a middle chapter, a turbulent interval where expectations are being recalibrated and leverage is being reduced. And recalibration is always uncomfortable because it forces the market to confront reality instead of narratives. Now, here is the contradiction that makes this moment so difficult to interpret. On one hand, sentiment is deteriorating. Headlines speak of fear, uncertainty, and doubt. Prices have pulled back from their peaks, and many participants feel as if momentum has been lost. But on the other hand, the structural forces that drove the previous expansion, scarcity, institutional adoption, and integration into global finance, have not disappeared. They are still there, operating quietly in the background, largely invisible to those who focus only on daily price movements. This is the point in every cycle where the psychological battle becomes more important than the financial one. Because markets do not just test capital, they test patience. They test perspective. They test whether participants understand the difference between noise and signal. And most people fail this test, not because they lack intelligence, but because they lack historical perspective. I want you to understand something from my years of watching markets. The most powerful moves rarely begin in moments of optimism. They begin in moments of doubt, when confidence is low and attention has drifted elsewhere. That is when foundations are built. That is when the next phase quietly takes shape, almost unnoticed. So when you look at this market now, do not see only the volatility. See the timeline. See the cycle. See how supply dynamics, institutional behavior, and macroeconomic conditions are interacting in ways that did not exist in previous eras. Because what you are living through is not just another correction. It is part of a larger transformation in how this asset class behaves, how it integrates into the global system, and how its cycles unfold. And the most important thing to remember, standing here in this moment of uncertainty, is this. Cycles do not end when fear is at its peak. They begin again when the market has absorbed enough pressure to move forward. The question is not whether the cycle will continue. The question is where. Within that cycle, we truly are right now. I want you to listen very carefully now, because this is the part that most people misunderstand in real time. Everyone wants to know the exact date when the nightmare ends, the precise moment when the market turns, the candle that marks the bottom. But after years of watching crises unfold, from currency collapses to equity crashes to commodity reversals, I can tell you something with absolute certainty. Turning points never announce themselves. They whisper. They appear first as small changes in behavior, small fractures in the trend, small signals that only become obvious in hindsight. Right now, those signals are beginning to emerge, but they are faint, fragmented, and easy to ignore. Volatility spikes are becoming shorter. Liquidation cascades are losing intensity. Price drops that would have triggered panic months ago are being absorbed faster. These are not dramatic headlines, but they are the kind of subtle structural shifts that often precede a reversal. Markets do not turn when everything looks strong. They turn when weakness stops accelerating. I want you to think about March 2009, when global equities bottomed after the financial crisis. At that time, unemployment was still rising, banks were still fragile, and economic data was still deteriorating. No one rang a bell to announce the recovery. The turning point happened while the news was still overwhelmingly negative. Or think about April 2020, when markets began to recover even as the global economy was still in lockdown. The lesson from history is clear. Markets move ahead of reality, not behind it. Now, let's bring that perspective into the present moment. What analysts are watching right now are not headlines but conditions, liquidity conditions, positioning conditions, volatility regimes. These are the signals that matter. When derivatives markets begin to stabilize, when funding rates stop swinging wildly, when open interest declines and then levels off, it tells you that the forced sellers, the most dangerous participants in any downturn, are gradually disappearing. And when forced sellers disappear, the character of the market changes. But there is another layer to this, and I want you to pay close attention to it because it is often overlooked. The macro environment is shifting slowly, almost invisibly. Interest rate expectations are no longer moving in one direction. Inflation data, while still uncertain, is no longer producing the same shock it once did. Central banks, even when they remain cautious, begin to change their tone before they change their policy, and markets are extremely sensitive to tone. Sometimes a single sentence in a central bank statement can shift billions in capital flows, long before any actual policy move occurs. This is how turning points begin, not with explosions, but with subtle changes in expectations. When investors begin to believe that the worst tightening is behind them, risk assets start to stabilize, not surge, not explode, stabilize. That stabilization phase is the bridge between fear and recovery, and it often lasts longer than people expect. Weeks, sometimes months, where the market moves sideways, frustrating both bulls and bears, exhausting traders who are looking for immediate direction. And during that quiet phase, something very important happens beneath the surface. Long-term capital begins to re-enter, not loudly, not visibly, but gradually. This is what happened in commodities after the 2015 collapse. It is what happened in equities after the 2002 bottom. And it is what we may be beginning to see now in digital assets. Accumulation does not look dramatic. It looks boring. It looks like low volatility, narrow ranges, declining volume spikes. And because it looks boring, most people miss it. Now, I want you to confront the contradiction that makes this moment so psychologically difficult. The headlines still feel negative. Some companies in the sector are still under stress. Sentiment surveys remain weak. And yet, at the same time, structural demand indicators are not collapsing. Network usage persists. Institutional vehicles continue to operate. Liquidity, while tighter than before, has not vanished. This creates a strange environment where fear and resilience coexist, and that coexistence is often the precursor to a turning point. I have seen this pattern too many times to ignore it. Markets reach a stage where bad news continues, but prices stop reacting as violently. That is one of the most powerful signals in all of finance. Because when a market stops falling on bad news, it means the selling pressure is being absorbed. And when selling pressure is absorbed, the balance of power begins to shift, slowly at first, then more decisively. But I want to be very clear about something. The end of a nightmare is rarely a single day on a calendar. It is a process, a sequence, a gradual transition from disorder to stability. People search for a date because dates feel certain, and certainty feels comforting. But markets do not operate on comfort. They operate on liquidity, expectations, and human psychology. So when you ask, when will the turnaround come? The honest answer is that it begins long before most people recognize it. It begins in these moments when volatility starts to compress, when forced sellers disappear, when macro signals become less hostile, when markets stop reacting to every negative headline with panic. That is how every recovery I have ever witnessed has begun, not with a sudden explosion upward, but with a quiet, almost invisible shift in the underlying structure. And if you are standing here with me now, watching these signals appear one by one, you are witnessing the earliest stage of that process. It does not feel dramatic. It does not feel triumphant. It feels uncertain, fragile, incomplete. But that is exactly how turning points always feel when you are living through them. Uncertain until the moment history looks back and calls them inevitable. Now I want you to imagine something with me, because this is the part of the story that most people fail to picture while they are trapped inside the storm. Every crisis feels permanent when you are standing in the middle of it. Every downturn feels like the one that will never end. But if you study markets long enough, if you watch enough cycles rise and fall, you begin to understand a pattern that repeats with almost eerie consistency. The period that feels the most uncertain is often the period just before the structure begins to rebuild. Right now, many people are focused only on survival, on volatility, on negative headlines, on short-term movements that seem chaotic and directionless. But what you need to understand is that markets are not just mechanisms of price. They are mechanisms of adaptation. After every shock, capital reorganizes, risk is redistributed, new leaders emerge, entire sectors evolve. And when you look back years later, you realize that what looked like destruction was actually transformation in progress. I want you to think back to the aftermath of the 2008 financial crisis. At the time, confidence in the banking system was shattered. Entire institutions disappeared. Credit markets froze. And yet, out of that collapse came a decade-long expansion in technology, innovation, and global liquidity. Or think about the early 2000s, when the bursting of the dot-com bubble wiped out vast amounts of speculative capital. For years, it seemed as if the technology sector had lost its momentum. But, beneath the surface, infrastructure was being built. Broadband networks, cloud computing, mobile platforms that would later fuel one of the greatest economic transformations in modern history. What you are witnessing now in digital assets carries the same underlying dynamic. The surface is volatile, uncertain, and emotionally exhausting. But beneath that surface, the ecosystem continues to evolve. Infrastructure continues to mature. Institutional frameworks continue to develop. Markets do not stand still, even when prices move sideways or downward. Progress does not always appear in price charts. Sometimes it appears in adoption curves, in regulatory clarity, in technological improvements that take years to fully reveal their impact. And this brings us to the critical question: what happens after the turnaround begins? Because recovery, when it comes, rarely looks like what people expect. Most people imagine a sudden explosion upward, a dramatic rally that erases all doubt overnight. But in reality, recoveries often begin quietly. Volatility declines, price ranges tighten, markets become less reactive to negative news, the emotional temperature cools, and only after this period of stabilization does momentum begin to build again. This phase, the stabilization phase, is one of the most misunderstood stages of any cycle. It feels slow, it feels uneventful, it tests patience. Traders who are conditioned to expect constant movement become frustrated. Observers who are waiting for dramatic signals conclude that nothing is happening. But in truth, this is the phase when the foundation is being rebuilt. It is the financial equivalent of reconstruction after an earthquake. The headlines fade, but the work continues. Now, I want you to consider another dimension of what may come next, and this is something that history teaches us again and again. Every major cycle creates new narratives. After the commodity boom of the 2000s, the narrative shifted to emerging markets and global trade. After the post-2008 recovery, the narrative shifted to technology and digital platforms. And in every case, the seeds of the next narrative were planted during the period when pessimism was at its peak. The same process is unfolding now. New applications, new institutional structures, new layers of integration between traditional finance and digital assets are developing quietly, often unnoticed by the broader public. By the time these developments become visible, the market environment has already begun to change. That is how cycles work. Innovation leads, price follows, and public awareness arrives last. But I also want to be honest with you about something, because realism is essential in moments like this. Recovery does not mean the absence of volatility. Markets do not move in straight lines. Even after a turning point, there are corrections, false starts, and periods of doubt. The road forward is rarely smooth, and that is why perspective matters more than prediction. Understanding the structure of cycles is more valuable than trying to forecast every short-term movement. If you stand back and look at the larger picture, what you begin to see is not a nightmare without end, but a chapter in a longer story. a story that has repeated itself in different forms across centuries of financial history. Boom, excess, correction, stabilization, expansion. The sequence changes in detail, but the rhythm remains the same. And this is the final thought I want to leave you with, because it is the one lesson that experience has taught me above all others. Markets are driven as much by human psychology as by economic reality. Fear expands during downturns, just as optimism expands during rallies. Both emotions distort perception, both make the present moment feel more permanent than it truly is. But cycles always move forward, whether we are ready for them or not. So as you stand here now, watching this market, hearing the noise, feeling the uncertainty, remember this: the end of a nightmare is rarely dramatic. It does not arrive with a single headline or a single candle on a chart. It arrives quietly, step by step, as confidence rebuilds, as liquidity returns, as fear slowly loosens its grip. And when that process is complete, people look back and say, the signs were there all along. And that is where we are now, not at the end of the story, but at the moment when the next chapter is beginning to take shape, quietly, almost invisibly, right in front of us.